Hey, good morning, everyone. This is Kirk here again at Option Alpha, the members only video update. It is Tuesday, January 10th. Haven't done a video update in a little while, so I wanted to get this out to you guys. Just starting to kick off earnings season here. Had Alcoa yesterday after the close. Better than expected guidance in revenue, but still a big loss. So we'll see what happens as we really start to get into the heart of earnings season, not next week, but really the week after. That's the big week. So here's just a quick chart of the reports by day. So you can see that yesterday there's just a couple. Today there's only one. And as we start to get into the next 2 weeks, that's when earnings season is really going to start ramping up. So it'll be important to start to see where all these companies are coming from. Last quarter, I don't think was as good as everyone thought it was. I think that stocks got run up at the end of the year with just some hedge funds and portfolios trying to regain what they've already lost through the year, and it was a flat year anyway. So I would definitely say that it's going to be pretty important to see some good earnings if we're going to continue this bullish move that we've had. On a bigger note, I think something that's really interesting and really not getting that much attention is that Germany actually sold bonds for negative yield yesterday. That was only by 0.01%, but the key here is that people who invest in Germany bonds are guaranteed to lose money. So if you sit back and think about that for a little bit, it really makes you wonder how bad investors over there think other places are if they're willing to put money into German bonds and willingly lose money. You got to think that getting $99 back on 100 might be better than getting $50 back on 100 if they invest someplace else like Germany or Italy or Spain. To really drive home this point, you got to look at the coverage ratio for what the bonds were selling at, and they were selling at 1.8 times coverage. So what that means is that there was 1.8 buyers for every bond that they wanted to sell. So they clearly had no problem at all selling the bonds. It was actually fairly easy, which is really what drove down the yields into negative territory. But that really drives home the point that people are now rushing to that safety net. So I wouldn't put it past us in the U.S. here over the next year, year and a half to see our bond yields possibly continue lower as probably the worse off place, right? Or the best looking ugly house in the neighborhood. So not to say that we're doing great or anything, and I still am very hesitant to add some positions with where volatility is and where the indexes are, and I'll go over that in a second here. But I think that it's something that could come here too. Negative bond yields, they've happened before in Japan. They're clearly happening in Germany now. So just be on the lookout for that. I think that was rather interesting and definitely something noteworthy. So if we get to the charts, God, I don't even know where to start today. There's so many charts that I wanted to briefly go through, so I'll kind of breeze through them. But of course, pause the video and email me if you have any comments on anything. I think the biggest thing is with the S&P right now where it's at. We knew that it was going to retrace half of the move from November. That was a given. It did that pretty easily, and now it's continued to move higher. What I think is pretty amazing, or not amazing, but just noteworthy again, is that momentum continues to be on a bearish divergence signal. So we have even tops here on the S&P if we even crawl up to the 1300 level, which we could definitely do. That's not without a stone's throw reach. But we have even tops and we have declining momentum. So that again to me suggests some bearish divergence. You saw it on the bullish side back in September, October, where we had massive increasing divergence, right? So massive momentum coming into the market as the market was making consecutive lows, which again is bullish divergence. So this divergence in the MACD. I think that all the indexes, relatively speaking, are pretty much at the same point. They're all starting to get back in towards this recent high area of 2011. You look at things like the Russell, we haven't quite got there yet, but we're starting to inch back up there. All of really the targets that I've been, or the support resistance lines that we've been watching have been pretty good, but now we're just kind of floating higher. You can see there's no meaningful move that we're having right now. It's not really justified. Again, yesterday was almost a 5-point day swing. I mean, really such extremely low volatility. And that's really been hard for traders like us because we don't want to get into the mindset of having to place a trade just to place a trade. You know, just having trades on the books just because we have trades on the books. I think that that can be devastating to your portfolio. When you look at things like the S&P, or the SPY, for example, you can see where the market is, right? It's definitely broken a good support line, or a good resistance line. So now we're back above that level, but we're definitely not out of the woods yet. Something like a 137 February option. So this oval that I've drawn up here is about where the stock would need to trade, or the ETF would need to trade by February expiration, which is right in this area here. So we need to trade up to 37. That's only about 2% right now. Maybe with commissions, it's going to be about 1.5%. So you can see that even on the call side, since volatility is so low, the markets are just slowly churning higher. You can't quite get as far away as you'd like. This is a very easy move if the market does something like this. Very easy move to get hit. And so that's why I'm hesitant to add positions at this point. On the put side, we have things that are trading at 110, 112 in this area. Those, again, are in the 2.5% region. And that's a quick move down. You can see it only took a couple days back in November of quick selling off from the level we're at to be right on that doorstep. And so I don't want to add positions right now with the volatility so low, and put premiums and call premiums so condensed and so minimal that it really just negates any risk reward you're having. At 1% or 1.5% up here, after you factor in commissions, that's not a good trade, in my opinion. I don't think that that's really a smart trade to be making in this market. The markets can obviously continue to float and just grind higher, which would not be good for that position. And on the flip side, if we make something down around the 110 region, at least on the SPY, then a quick move is going to really hit that position out. And again, we're giving the market about 40 days here with February. So January is pretty much behind us. What we have in the portfolio is what we have. We're going to make some good money in January, which is good. You know, small returns, obviously great. Could have made a little bit more if we really added the positions in at the end of the year, but there's really no point in doing that with the VIX as low as it is. We're going to wait for better opportunities throughout the year. So we take a look at the VIX now. You can see that the VIX is now on the doorstep of 20, which is really complacent territory, in my opinion. It can stay down there for a long time, so just be aware of that. It can be in the 20 range for a little while. I definitely think that we'll start to see, you know, little pops here and there towards the 25 range, but it's going to need a good catalyst to get it back up into the upper 30s. So you can see how great the end of last year was for us, and why we did so well trading is because the VIX was so high, premiums were spread. So it's a different ballgame. And again, like the posts I mentioned or sent out the other day and posted on the blog, you know, for me, it's more of a return of capital versus a return on capital sometimes. I think that you need to be in the mindset of trading when good opportunities arise, not in trading every week or every other Thursday. You don't need to get on that type of a schedule. The last thing I want to take a look at here tonight is chart of crude. Crude has been really interesting to chart. These channels I've actually had for the past 3 years now, these channel lines. And crude has followed them lockstep. It's amazing. You can see that since 2009, it's just right in one channel, it dips down to the next. Now it gets up to the next one. Now it dips down. And just really, really good chart to watch and continue watch. It's going to be a good bellwether for the markets. So I think that now that we're at the resistance level, it's kind of make or break, right? We're hitting a Fibonacci level, which has been historically strong. So I think we could see some selling off in crude, which would, again, relate to some equities starting to sell off a little bit, giving us the opportunity to enter some positions with a higher VIX. So as always, hope you guys enjoy these videos, and please leave me comments or shoot me an email if you have any questions, and happy trading.